Are you ready for a financial roller coaster? The Fed has announced a rate hike and the stock market is bracing for impact. Join us as we delve into the potential consequences of this decision and explore how it could affect your investments. If you're interested in investing in stocks and still haven't started yet, you can consider starting investing with Acorns. Click the first link in the description to know more. Now on with the video. The correlation between the recent decline in the stock market and the rise in interest rates cannot be ignored. The S&P 500 has taken an 8% hit since the Federal Reserve started raising interest rates in March 2023, following a long haul since December 2018. While the link between interest rates and fixed income is widely acknowledged by investors, it's important to note that interest rates also have an impact on equities. Specifically, companies' profitability is affected, sectors experience specific impacts, growth potential may be curtailed, and exchange rates fluctuate. As investors navigate the choppy waters of the stock market, understanding how interest rates can impact stocks is crucial to making informed investment decisions. Now, let's look at some key metrics of the stock market and businesses that got impacted by the Fed's decisions. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. Number 4. Affecting businesses' profitability. It's not just investors who feel the effects of higher interest rates. Companies are also impacted in numerous ways. Firstly, a rise in interest rates means companies have to pay more interest on their own debts, causing their expenses to go up. Additionally, higher interest rates translate to higher costs for customers who may cut back on their spending, ultimately impacting the company's top and bottom lines. The slower growth and reduced profitability that often follow also mean that the present value of future cash flows declines, leading investors to pay less for a given unit of earnings. As Gerald Wills, CEO and co-founder of GYL Synergies in West Midtown, Connecticut explains, as interest rates increase, the cost of borrowing capital increases for companies. This in turn reduces earnings. Comment stocks if you would like us to make more videos like this in the future. Number 3. Impacting the specific sectors. The impact of interest rate changes on the stock market is a well-known phenomenon, but the effects can be complex and vary depending on the industry and company involved. As interest rates rise, investors may be drawn towards fixed income products as an alternative to cash investments. This trend was observed in 2022 when a sell-off occurred due to the potential for lower future cash flows. The S&P 500 is down more than 8% since the Federal Reserve began increasing rates for the first time since December 2018. This decline roughly parallels the rise in interest rates. One way in which higher interest rates affect companies is through their expenses. However, different sectors of the market are affected differently. For example, the energy sector returned an impressive 61.93% in 2022, far outpacing other categories. Sid Max, the U.S. chief investment strategist at TD Wealth in New York, notes that certain market segments are historically more sensitive to interest rate changes. The real estate sector, for example, is significantly impacted by changing rates due to the cost of mortgage financing, which can impact housing affordability and property market values. On the other hand, consumer staples tend to be more resilient as they focus on essential goods and services. Linda Gray, the senior equity strategist at Federated Hermes in Pittsburgh, explains that bank stocks benefit from rising interest rates, as loan rates often rise faster than interest-bearing deposit accounts, which is a crucial factor in bank profits and stock prices. Meanwhile, technology stocks, categorized as growth, fell last year, while some regional banks bucked the trend and ended the year with price gains. It is essential to understand that interest rates do not affect all asset classes equally. While some sectors may be sensitive to interest rate changes, others may be more resilient, and investors need to consider these factors when making investment decisions. Don't forget to like this video if you've watched it till now, as it inspires us to make content like this. Number 2. Facing a cap on the growth of companies. In the world of investing, growth stocks are companies that prioritize increasing their revenue and expanding their operations over earning profits. However, as interest rates rise, growth stocks may face challenges in maintaining their strategies. According to David Miles, founder and CIO of investing firm Reason Financial Advisors, higher interest rates can significantly reduce the time value of future growth for these companies. Additionally, if a company is unprofitable, it may need to raise capital by issuing more stock or taking on more debt to continue operations until it can become self-sustaining. Unfortunately, with higher interest rates, the cost of servicing debt also increases, which further eats into any potential profits. As a result, investors may become less willing to invest in growth stocks, leading to a decline in share prices. Moreover, growth stocks are typically more sensitive to interest rate changes than other sectors, such as value stocks or dividend-paying stocks. As a result, investors may choose to allocate their funds elsewhere, such as bonds or fixed income securities, which become more attractive as interest rates rise. Despite these challenges, growth stocks can still offer attractive investment opportunities. Some growth companies may be able to weather the impact of rising interest rates, particularly those that have strong balance sheets, high levels of cash, and minimal debt. Additionally, companies that provide essential goods or services may still see demand growth despite higher borrowing costs. And finally, number 1, impacting exchange rates. According to Miles, foreign exchange rates have a significant impact on the tech sector, but it's often overlooked. He explains that the global financial system considers U.S. Treasuries to have a low probability of default. As a result, U.S. Treasury rates are among the highest compared to other countries with high-quality debt. Non-U.S. investors seek relatively high returns with low risk, which leads to an increase in demand for U.S. dollar-denominated treasuries. Consequently, the value of the U.S. dollar also increases. For companies that sell digital goods, the higher value of the US dollar translates to effectively higher prices for international customers. Miles notes that this can impact demand for software or services. The tech sector, which is heavily reliant on international customers, may see lower demand for their products due to the increased prices. This can be a significant concern for companies that rely heavily on international sales. It's important to note that the impact of foreign exchange rates on tech companies can vary based on several factors. For instance, companies that have a significant presence in countries where their local currency has weakened may be less affected. Additionally, companies that have a larger domestic customer base and less reliance on international sales may not be as affected. However, for companies that operate in a highly competitive market, any increase in prices can result in a loss of market share. Thus, tech companies need to consider the impact of foreign exchange rates on their business and take appropriate steps to mitigate the risks. So that's it today for you guys. And don't forget to check out the first link in the description to start investing with Acorns.